Chapter 14, Financial Statement Analysis. Chapter 14 is kind of fun because this is the point where we quit doing debits and credits and we sit down and we say, okay, we've already figured out how to do a balance sheet, do an income statement, do a cash flow statement. What does it mean? We actually are starting to analyze things. And so it's broken into two major categories. There's the first section where it talks about trend analysis, and then this last half of the chapter which talks about ratios. So there's a lot of math, a lot of numbers on the trend ratio, trend analysis. I don't want to spend a lot of time on that because I'm not going to give you any problems on horizontal or vertical analysis because, quite frankly, it's just math, and this computer will do it for you if you do your financial statements. But there are a couple concepts I want you to know because you might see a question or two that pops up on that. So let's talk about horizontal analysis. Horizontal analysis is where you're going across and you're showing something for between 2 years. So let's say you have a real simple income statement, net income, and then you have expenses, not income, net revenues, sorry. Net revenues, expenses, and net income. And let's say you have 2016, say $1,000 and $700, and so this is $300. And then you had last year, you had 2015. So you look at 2015, and let's say that was $800, and this was $600, and so your total was $200 net income. Okay? Well, horizontal analysis does just what we're talking about. We look at things horizontally between years. And so the basic calculation is very simple. We're going to go over here and we're going to take the difference and we're going to have an increase or a decrease. And then we're going to have it in two ways. We're going to have dollars and percent. So the dollars, this was $200. It was an increase because it went up from 2015 to 2016. This went up $100, and this went up $100. The percentage is going to be always, the base year is the earliest year. So 200 divided by 8 is going to be, what would that be, 25%? 100 divided by 6 would be, I think that's like 17%. And of course 100 by 200, that's 50%. And so what you do is you go through and you can calculate the numbers. Again, your earliest year is always your base year. So that's important to know. And then you're using these percentages. And then you're looking to see what the big changes are. The whole idea is you got a balance sheet, you got an income statement, you got a lot of numbers. What numbers do I look at? Well, I look at the numbers that make a difference. What ones that make a difference? The ones that changed. This just let me see which ones either had a big dollar amount change or a big percentage change. This is the most common form of financial analysis you're going to see. You're going to see this, compare this year's numbers to last year's numbers, compare this month to the budget, this year-to-date actual numbers to year-to-date budget. You're going to see this all the time. So everybody's going to see this. So this is the simplest form of horizontal analysis. Okay? You also have something called trend analysis where you have more than 1 year. And the way that might work, let's say we decide we want to go out to more than 1 year. Maybe we want to go to 2014 and 2013. And let's say this is 600, and let's say this is 400. Well, the idea is if we have a lot of numbers, again, people's eyes tend to glaze over and roll into the back of their head when they look at pages that have too many numbers on them, right? You guys are in accounting, you know how that goes. So the smaller the numbers, the easier we can make them to read, the easier it is for people to understand them. So what we do is we, again, use this as our base year. So when we're doing a trend analysis, we're always using the earliest year as our base year. And so we would do 400 divided by 400, and we'd say that's 100%. Then we come over here and we'd say 600 divided by 400. That's, what is it, 150%. And then we just go through, and when we're done, we end up with something that looks like this. 100%, 150, 200, 250%. So somebody can say, how much was the growth between 2015 and 2013, 2015? They say, it looks like it went up about, it doubled, it's 100%. Because it's easier to talk percentages than dollars. So, and you would do that for all the lines going across, okay? So that's trend analysis. It's just horizontal analysis with more than 2 years, okay? Any questions on that? That's pretty straightforward. So the only thing you might need to know is I might ask you when the base year is, what the base number is. And the base number is always going to be what? The earliest, the first year, okay? Another form of analysis that we do is something called vertical analysis. Now, honestly, it doesn't get used that much. Horizontal, we're looking at numbers across. Vertical, we're looking at numbers up and down, okay? As a matter of fact, what we're doing is we're looking at numbers based upon how they compare to one another. So we always use, in this case, the net revenue number is the base number. So we divide everything by this number. So 1,000 divided by itself is 100%. 70 divided by 1,000 is 70%. 30 divided by 1,000 is 30%. And the idea is if you did that vertically on an income statement, you could go through and you could see, especially if you did 2 years like this, you could compare these 2 years horizontally and you could see which percentages changed the most. And that would tell you where you needed to ask the question, what's happening? So it's a pretty handy tool. On the balance sheet, the base number that you use is total assets. So all the numbers up above are divided by total assets. Okay? So that's vertical analysis. And again, I'm not going to ask you to do any of that, but it's something that's pretty useful, and if you're using a computerized software package for your financial analysis, it's a button that you click, and it does it automatically for you. But it's really a useful tool. Okay? So that's horizontal and vertical. That's the first half of the chapter. So that's not much you're going to have to worry about. Mainly what you're going to have, though, are going to be questions on ratios, because I think ratios are really helpful. Because ratios let us look at things that we wouldn't normally see just by looking at a whole balance sheet or income statement. Ratios let us look at two numbers that maybe might even be on different schedules. Some number might be on the income statement, one might be on a balance sheet. We compare them to see what they say. Now, I'm not going to go through all the ratios tonight, okay? As a matter of fact, you're not even going to have to memorize all the ratios, because I'm going to give you all the ratios, but I'm not going to tell you what they are. You're going to have to remember them. So if you go over on page 676, you're going to see all the ratios that are over there. Okay, so the formulas, I'm going to give you the formula, but I'm not going to tell you the title. So you need to be able to know them well enough that when you look at when I say, oh, calculate a payout ratio, you know what the formula is when you look for it. Okay? But there's three things you're going to have to know in the ratios. Oops. So the first thing you're going to need to know is how to compute them. How to calculate or compute. Calculate ratios. So like I said, there's probably like 20 multiple choice questions on here. Probably roughly half of them, or a little less than half of them, are numbers that I'm going to give you a balance sheet, an income statement, and say, calculate the ratios. And you've got lots of homework problems to practice that, so you should be able to see there's some averages and that kind of stuff you have to worry about. So you need to go through and you need to know the formula so that you can figure out the formula when I ask you to calculate profit margin or whatever it is. But you're going to have to calculate it. The second thing you're going to have to know is you're going to have to know the classifications. Now, what does that mean? Well, if you look on page 676, you have three major classifications, right? You have liquidity ratios, and then you have profitability ratios, and then you have solvency ratios. And under each one of those, you have the ratios listed. So under liquidity, there's current ratio, asset test, quick ratio, accounts receivable turnover. The accounts receivable turnover, there's another ratio that's called days in collection. So you want to know how to calculate that. It's not on here, but it's in the book, and that will be something that will be on the test. You should know that. You have inventory turnover, and there's also a second version of that in the book, in the text, called days in inventory. So you need to know how to calculate that and how to interpret that. So what will happen is I'll go through and I'll say, if you were interested in a company's liquidity, which of the following ratios would you use? And I'll give you 4 ratios, and you need to know which one of those is liquidity, because I might give you 2 solvency ratios and 2 profitability ratios. The idea is you need to know what these things are. Okay? Well, how do you know what liquidity is? That's where I need my notes. If you go over on page 667, you see liquidity ratios. It tells you the definition of liquidity ratios. They measure the short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. Okay. Profitability ratios, what's the definition of profitability? Well, profitability, over on page 670, says it measures the income or operating success of a company for a given period of time. And you can see, again on 676, the list of profit margin, asset turnover, return on assets, return on common stock equity, earnings per share, price earnings ratio, payout ratio. All those would be profitability ratios. The last category is the easiest because it's only got 2 ratios. That's solvency ratios. And the definition for solvency on page 676 is measures the ability of a company to survive over a long period of time. So that would be the debt to asset ratio and times interest earned. So you're going to need to know the classifications of what ratios go in these categories and the terms, the definitions, because I might not say, hey, which one of these would you calculate if you wanted to know about a company's solvency? I might say, hey, if you were concerned about the company's ability to survive over a long period of time, which one of these ratios would you want to calculate? And you need to know, oh, he's asking about solvency. Which one of these 4 ratios are one of these 2 solvency ratios? So you see what I'm getting at? I want you to, you can always look up the formula, but I want you to know which ratio you want to use to calculate which attribute. Okay? The third thing that you're going to need to know is how to interpret the ratios. In other words, if you see a ratio and you calculate it, it's changed. Did the change, was it a good change or a bad change? Now, the general rule is everything when it increases is good. If you aren't for sure what to interpret, assume that if it went up, it's increasing, that's a good thing. The only ones that aren't really good is like your debt to asset, because that means it's riskier, because you're taking on more debt, okay? Possibly you could say your, what was the other one was on here? That was a riskier one. Price to earnings, PE ratio, because a higher ratio just means your stock's more expensive. But all the other ones, an increasing ratio is typically a better thing. Okay. Now I'm not going to go through each one of those because I put an announcement on Canvas that listed out all these categories and put together how to interpret them. Okay, so you should maybe get flashcards out and start going through and remembering. It's old school, low tech, but it's an easy way to learn it. Because about half the questions you're going to get are going to refer to looking at the ratios and knowing one of these things here, how to classify them and how to interpret them. Some of the problems are going to look like this, where I combine the interpretation and the classification. And you'll see a couple of these on the Chapter 14 quiz, because I put them in there so you can get kind of used to them. I might go through and say, if you are a banker and you are concerned about a company's ability to meet unexpected needs for cash. So you have to think to yourself, oh, he's asking about liquidity, okay? So, but I won't tell you that, you need to know that. And then I would say, which of the following ratios would you be concerned about or would bother you? And I'll give you 4. And I'll say, an increasing asset turnover ratio. And you go, well, asset turnover, that's profitability. And increasing is good, so I wouldn't be worried about that one. And that's not what I want to worry about anyhow. I would say, an increasing inventory turnover ratio. You go, inventory turnover, that's liquidity, but if it's increasing, that's a good thing, so I wouldn't be worried about that. Okay. Then I would say a decreasing price to earnings ratio. And you go, well, that's a profitability ratio, so I wouldn't really be concerned about that because, and decreasing price to earning doesn't really affect liquidity, so I wouldn't be worried about that one. Or then I would say a decreasing current ratio. And you go, aha! Current ratio, that's a liquidity ratio, and it's decreasing, that's a bad trend. That's the one, if I was a banker and I was concerned about their liquidity, I would be worried about. So the answer would be D. See how that works? So you'll have to go through, you'll have 4 ratios. You'll need to figure out which ones are the right classification, and then if there's 2 or 3 in the right classification, or even 4, then you got to figure out which one is the one that's not going the right direction. So you can expect 2, 3, or 4 questions that are like that, because it kind of combines the interpretation. Okay, so that's what you're going to get on the ratios. What else did I tell you about ratios? Interpret them, practice them, look at the tips, the study tips for chapter 14, and pretty much summarize. That's what I was going to print out and write up here, but you guys can look it all up. It takes too long to write it up anyhow. The only other thing that's at the very end of the chapter they talk a little bit about is discontinued operations and how it's broken out in the income statement separately. The idea is that if I have a business and I'm going to get rid of a significant part of my business, not just 1 or 2 stores, but I'm getting rid of like a whole group of stores, or maybe I have a business in Los Angeles and a business in Phoenix, I'm getting rid of the one in Phoenix, that I want to go through while I'm getting rid of that and take those discontinued operations, because I'm not going to keep doing them, and separate their revenues and expenses from my continuing operations, because I want to be able to show over time what my continuing operations were. So I don't want to have the old stuff that I'm getting rid of mixed in with the new stuff, so I separate them. So there's 2 sections. There's a continuing operations where you have all your detail and your income statement, and then down below you have a discontinued operations section where you put the net number, 1 number for your income or loss from running it till you get rid of it, and then 1 number, a gain or loss from going through and actually closing it and shutting it down. So not a lot on that. Maybe if you get a question, I'll be surprised, to be honest, but I don't think I have a question on that. But that would be the only thing in that section. Discontinued. What is a discontinued operation? What do you do with it? Okay? And that's pretty much it for chapter 14, ratios.